This bank had problems because in 2008, under the Dodd-Frank, they were allowed to invest in assets. Now, it wasn't a bad decision necessarily to invest in these assets. A lot of these investments were now underwater. People start withdrawing money. Tech companies were doing a little bit more poorly, as we know. They start having less capital. There's less money going in. So what happens is that the bank now has to make up this money.
Silicon Valley Bank failed after depositors, mostly technology workers and venture capital-backed companies, started withdrawing their money, creating a run on the bank. The bank had approximately $209 billion in total assets and about $175 billion in total deposits. As of 31st December of 2022, this is Silicon Valley Bank.
This bank had problems because in 2008, under the Dodd-Frank, they were allowed to invest in assets. Now, it wasn't a bad decision necessarily to invest in these assets, but what happened was that they were yielding on $82 billion worth of investments around 2%. A lot of these investments were now underwater. You see, when you invest in a lot of the bonds that they invested in mortgage-backed securities. So a 3% mortgage equals a 2% coupon because everybody takes a piece. So 2% coupons, I'm getting 2%. That's okay if I'm paying a half of 1%. I'm making money on it, okay? You can move your money to a short-term 6-month treasury and get 5%. So people start withdrawing money. Tech companies were doing a little bit more poorly, as we know. They start having less capital. There's less money going in. So what happens is that the bank now has to make up this money. They had on their books $12 billion positive, but it really wasn't. Because once you started looking deep, what they had was invested in these bonds that were now underwater. Under Dodd-Frank, these are considered now to be no-risk assets. This was not a solvent bank. They were $3 billion unsolvent as at the end of last year, which is why the CEO was selling stock, which is why you had insiders getting paid bonuses up front and early. Now, they start to get exposed because Jim Cramer, an amazing 5 weeks ago, touts this as the stock you got to buy. So Jim Cramer on February 8th talks about how the stock's undervalued, how it has room to run, is his quote. It was at $320.
Year to date is SVB Financial, don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings.
Here's why this is significant.
Yeah.
Because this draws attention to SVB. Now, whether you want to think of it as an investment or not, now people start digging in. And as people dig in, what do they see? They see this $15 billion in unrealized losses that they didn't have to report. But now that you dig in, and what do they start telling their clients? They start telling your clients, hey, you know what? This bank is vulnerable. I'd probably take my money out of there.
So let me just give some of the stats. If you can show have this here. 16th largest bank. 97% of the money at Silicon Valley Bank is not protected by FDIC. I've seen 93%, I've seen 97%. Whoever's right, one of the two. Either way, it's a lot of money. 12 days ago, like 13 days ago, the CEO, Gregory Becker, sold 11% of his shares. Daniel Beck, the CFO, sold 32% of his holdings. CMO Michelle Draper sold 28% of her holdings, around $5.1 million. If you post a picture of Forbes just 7 days ago.
This one right here.
By the way, they took the tweet down, just so you know, that's the one I posted, but
yeah,
they took it down. This is 6 days ago. Proud to be on Forbes' annual ranking of America's best banks for the 5th straight year and to also have been named the publication inaugural Financial All-Stars list. They tweeted this. I retweeted this. They took it down because they obviously, I'm sure a lot of people were retweeting this. This was all over the place. They don't want people to see. Just 5 days ago, you're bragging about this. So this becomes the question. There's a terminology called front running. Front running, let's just read the exact definition. The practice by market makers of dealing on advanced information provided by their brokers and investment analysis before their clients have been given the information.
On March 1st, Becker was at an event in Los Angeles, and he said, we pride ourselves on being the best financial partner in the most challenging times. He had already been told that there was a call coming from Moody's. Moody's had looked at a footnote that was in there. Because remember, they don't have to disclose everything in standard parlance in a quarterly earnings report, but they did footnote in the details page that they had the $15 billion. Moody's saw that and came back and said, hey, we have a question. If you were to look at this as a mark to market rather than a mark to maturity, where are you at here? Because our assessment is we're going to lower you 2 ratings levels, Pat. 2. And he said, what do we have to do? You have to clean this up. And part of the plan to clean it up, exactly as Barry just said, sell 20 billion of it, but technically that's depositor money.